The major banks across the United States are quietly preparing for a huge year in 2026. They're hiring and expanding their mortgage departments, and they're projecting what industry reports call robust loan issuance. But here's the problem. Housing inventory is still low. Millions of homeowners are still locked into their 3% mortgage rates, and every headline says nobody's selling. So let me ask you this. If there aren't enough homes to buy, why are banks betting millions of dollars that 2026 will be one of the busiest lending years we've seen since the pandemic? Either the banks are wrong, or they know exactly where a wave of new inventory is coming from, and most people aren't seeing it yet. Today, though, I'm going to show you the evidence, then try to explain where this shadow inventory could be coming from. More importantly, if the banks are right, we got to figure out what you should be doing right now to capitalize. Let's start with where the speculation is coming from. If you pull recent industry outlooks from groups like S&P Global or the Mortgage Banker Association forecasts, or really any major bank earnings calls, you can see an optimistic sentiment from all of these forecasts. Robust mortgage issuance expected in 2026. That doesn't read as a hopeful guess. That's a staffing and capital allocation decision. Banks don't hire loan officers, processors, and underwriters speculatively. They hire when models show volume is coming. Now, compare that to what we all see on the consumer side. Inventory charts still show we're well below pre-2020 levels. Listings remain tight and the average days on market are trending longer. Not to mention record levels of sellers delisting their property from the market indicates that many sellers with low rates are sitting comfortably. So here we are again. The math doesn't add up. If inventory stays frozen, loan volume can't surge. What all that means is banks aren't betting on today's market. They're betting on change. I've been trying to figure out what these groups are seeing out there. Is there some housing inventory hiding in the shadows? Or where exactly is the surge in home loan sales or loan production possibly coming from? Thinking this over and over again, I can only conclude that there are really only three places it can show up. The first theory is simple. Builders create new homes and inventory. Yes, construction has increased compared to the post-COVID slowdown, and yes, builders are offering incentives and rate buy-downs, but here's the problem. New construction alone cannot flood the market fast enough for this to make sense. Building materials are volatile, labor is constrained, not to mention that zoning and permitting still slow everything down. All that to say, without a doubt, builders help at the margins, but that doesn't explain why banks expect a major surge. So it could be part of the answer, but it isn't the main answer. Interest rates. This is where things get interesting. There's a growing consensus inside the lending community and bond markets that rates in the mid 5% are the psychological breaking point. Not 3%, not 4%, but roughly 5.5% to 5.75%. Why is that? Because at that level, a huge number of homeowners can move without blowing up their budget with their new mortgage payment, especially if they have equity. Right now, sellers aren't frozen because they don't want to move. I know that I've talked to more than a few who really want to move. A lot of these sellers are stuck because the difference in what their payment is now and what it would be simply hurts too much. Okay, maybe this is something we're onto here. Let's play the tape forward and think about what might happen if this psychological hurdle is cleared and rates drift into the mid 5s. So downsizers list their properties, move-up buyers list their properties, divorce, job changes, and life events finally turn into listings. This wouldn't be panic selling. It's more permission selling. Yeah, I'll go with that. Think about it though. If the psychological block of the new house payment is alleviated by lowering interest rates, People are more likely to give themselves the permission to house shop again without as much of the payment shock. And banks appear to be betting that 2026 is when that permission arrives. Lastly, let's address the elephant in the room. Is there a hidden crash coming? The short answer, no. Certainly not in the sense that we saw in 2008. I feel very comfortable saying that because today, most homeowners have a lot of what the homeowners who were drastically affected by the '08 crash didn't have. Most homeowners today have fixed rates, have strong equity, and quite frankly, they were approved through strong underwriting guidelines. But all that doesn't equate to zero stress. It doesn't mean that there aren't current homeowners who are feeling squeezed or simply unable to keep up with their mortgage payment. Mortgage foreclosures are starting to tick up again. What we are seeing in a lot of these instances are a result of rising property taxes, insurance costs keep climbing, and job volatility in certain sectors, leaving families with half or less of their usual income. That would create selective pressure and sales that trend more to the panicked side. As a result, we may likely expect distressed sales to increase slightly, but not nearly enough to justify the robust issuance forecast. So here again, like possibility A, not the primary driver. The banks are not betting on a crash. They're betting on the freeze thawing, perceptions unlocking, and change. They believe rates normalize just enough, sellers will begin to regain their mobility, and that housing inventory takes care of itself and rises organically. And if that happens, transaction volume rises organically as well. So if these forecasts are right, what should you be doing right now? Because here's the mistake most people make. They wait for the headlines to confirm the opportunity. By then, it's already crowded. If you're a buyer, have your budget handy to know your payment comfort zone. Then stay in that zone. Start up conversations with a lender and consider getting pre-qualified sooner than later. Keep track of the neighborhoods that check the major boxes rather than tracking national headlines. When inventory unlocks, competition comes back fast. The unprepared buyers are left chasing, while those buyers who took the time to prepare get to capitalize on their opportunities. If you're a seller, understand this clearly. 2026 could also reward sellers, but only the ones who list early in the cycle. The first wave of inventory gets attention, serious buyers, and with that comes better negotiating leverage. Late sellers compete with everyone else who waited too long. Preparation matters more than timing. And if you're an investor, banks expanding capacity means liquidity is coming back. That matters for financing availability, exit strategies, and refinance windows. The best investors aren't waiting for certainty. They're working on positioning themselves before momentum becomes obvious. Banks aren't emotional, and they don't hire thousands of people unless the math works. If they're preparing for a busy 2026, we should pay a little bit of attention. Because one of the biggest mistakes in real estate isn't buying at the wrong time. It's being unprepared when the opportunity shows up. If you want help building a plan, whether you're buying, selling, investing, that's exactly what this channel's for. Hit subscribe, drop a comment, let me know what you're thinking. The banks are already preparing. Now it's your turn.